Welcome back, everybody. Ready to dive into another deep dive?
Always ready.
All right. Well, this time we're tackling Benjamin Graham's classic, The Intelligent Investor.
Well, classic.
Definitely a must-read. Whether you're thinking about making a big financial decision, finally ready to decipher all that Wall Street jargon, or just curious about building real wealth, this book it's like the holy grail.
Yeah.
We've got Graham's timeless advice, of course, but also some updated commentary from Jason Zweig, and even some wisdom from Warren Buffett himself.
Oh, wow.
So get ready. We're going to uncover the real difference between investing and speculating, why ignoring the market might be the smartest move you ever make.
Interesting.
And how to, start thinking like a business owner, not just a stock trader. Ready to jump in?
Absolutely. Let's dive in.
Okay, so right off the bat, Graham kind of throws us a curveball. He's like, intelligent investing isn't really about having some genius IQ. No. It's more about your temperament, patience, discipline, having a thirst for knowledge, and that crucial ability to keep your emotions in check.
Yeah.
So I'm curious, in today's world, with all the instant gratification and the market's ups and downs, I mean, is that even possible?
I think it's even more crucial now than ever, I'd say.
Really?
Oh, yeah. Think about it. We are absolutely bombarded with information everywhere we look. Everyone's always looking for that next, hot stock tip. And it's so easy to get swept up in that, fear of missing out,
Oh, yeah.
But what Graham is saying is basically slow down, think rationally. Don't let your emotions make those decisions for you.
So it's almost like resisting that urge to buy now, think later.
Exactly. And that leads us perfectly into his big distinction between investing and speculating.
Right.
Investing, he says, is about owning businesses and really benefiting from their long-term growth. You're searching for companies with those, really solid fundamentals and the potential to actually create value over time. Speculating is more, I guess you could say, it's like gambling,
Okay.
It's more about betting on those short-term price movements, hoping to make a quick buck. It's the difference between, I don't know, owning a house and just flipping it.
Right. Okay, that makes sense. But how do we avoid getting caught up in that frenzy, especially when you see people making a fortune practically overnight? It's tempting.
That's where Graham's brilliant Mr. Market analogy comes in. He really wants you to visualize the market as this unpredictable character who just shows up at your door every day, offering to buy or sell your business interests. Okay. Some days, he's euphoric, he's offering you these crazy prices. Other days, he's just down in the dumps, practically begging you to sell at a loss.
Right.
But here's the important part. His offers, they're totally irrational, driven by emotion and that short-term thinking.
So it's like he doesn't really know what he's talking about.
Yeah.
But Graham wrote this book decades ago. Is this whole Mr. Market idea, is it still relevant in this digital age we're living in?
Oh, absolutely. It's probably even more relevant now with social media and the news cycle being 24/7. We're constantly bombarded with information, opinions, and all of that can amplify those market swings and make it even harder to stay rational,
Right.
But the thing is, the key takeaway is you have the power to choose how you respond to Mr. Market's craziness.
So how do we resist those emotional swings and make the smart decisions?
Well, that's where Graham's concept of the margin of safety comes into play. This is all about never overpaying for an asset.
Okay.
You want to buy it for significantly less than its intrinsic value, even if it means, maybe missing out on some potential upside.
Right.
It's like buying a car on sale. You're getting a great deal and you're kind of protected if something unexpected happens down the road.
So if I'm looking at a company, how do I even figure out its intrinsic value? I mean, it's not like there's a price tag just hanging on it.
That's where the detective work comes in.
Okay.
You've got to look beyond all the hype, the headlines, and really dig into the company's financials, look at their earnings, how much debt they have, their competitive advantages. But just as important, what are the potential risks involved? You're looking for, a real bargain, a company that's trading for less than it's actually worth.
So it's about finding those hidden gems that the market's just kind of overlooked.
Yes.
That sounds like a lot of work, though.
It can be, but Graham, he gives us a great example. In 1973, the Washington Post Company, they were trading for about $80 million.
Okay.
But Graham, after analyzing their assets, their earning power, he calculated that they were actually worth closer to $400 million.
Wow.
That's a massive margin of safety.
That is a huge difference. So he was basically buying $1 for like 20 cents.
Exactly. That's the power of that margin of safety. It protects you from that downside risk, and it gives you a cushion, even if your calculations aren't absolutely perfect. And this principle, it's especially crucial now, with all the market volatility we've seen and the rise of these really high price growth stocks.
Right. I totally get that we need to be careful with those high flying growth stocks. But what about Graham's think like a business owner idea? Can you break that down a little bit?
Sure. It's really about shifting your perspective. Instead of viewing stocks as just these, little tickers on a screen, think of them as pieces of real businesses. Ask yourself, if I own this entire company, would I be happy with how things are being run? Would I be confident in their future? That's the mindset Graham wants you to cultivate.
So it's like going beyond just reading the headlines.
Yeah.
And really understanding the company's operations, the management team, the whole landscape.
Exactly. Graham gives us this fascinating example. He discovered that Northern Pipeline Co. was actually trading for less than the value of the bonds it held.
What?
He bought the stock, agitated for a dividend increase, and walked away with a pretty handsome profit.
Wow.
He saw an opportunity that the market had totally missed because he was thinking like a business owner.
So he basically got the company's actual pipeline assets for free.
Pretty much.
That's incredible. But okay, so this doesn't mean we all have to become Wall Street gurus,
right?
Or spend hours, poring over financial statements,
right?
But it does mean being selective and understanding the fundamentals of the businesses that we're investing in.
Exactly.
Okay, that makes a lot of sense. So we need to be cautious with those high flying stocks. Think like business owners.
Yeah.
And remember that Mr. Market can be, well, a little irrational. Anything else we should keep in mind?
Graham has a lot more to say.
Okay.
But one key takeaway is to be wary of what he calls growth stocks.
Okay.
These are companies that are, expected to grow at a very rapid pace. They often come with sky high valuations, which can be pretty risky for the average investor.
But aren't growth stocks the ones that, make people rich? I mean, everyone talks about finding the next Amazon or Tesla.
Yeah, that's the allure, right?
Right.
But Graham, he shows us that even companies with, those stellar reputations and seemingly bright futures, they can still suffer massive price drops.
Really?
Oh yeah. He gives the examples of IBM and Texas Instruments, and back in his day those were considered, blue chip stocks.
Wow. So even those safe growth stocks can be risky.
Exactly. And this is really relevant today. Think about the dot-com bubble back in the late 90s or even those recent tech stock crashes.
Right.
History has a way of repeating itself.
It definitely does.
Yeah.
So how do we manage that risk? I mean, should we just avoid growth stocks altogether?
Not necessarily, but we need to be extra cautious. Graham's advice is to really focus on value, not just growth. Look for those companies with those solid fundamentals, a proven track record of profitability and a reasonable valuation. Don't get caught up in all the hype.
Right.
And always remember that margin of safety.
Always. So we've talked about, thinking like a business owner, looking for that margin of safety, being cautious with those high growth stocks. What other strategies does Graham recommend, especially for someone who's, ready to really roll up their sleeves and get involved with their portfolio?
Well, that's where his insights for the enterprising investor come in.
Okay.
Now, don't let the name scare you. It doesn't mean you have to be some Wall Street, hotshot.
Right.
It just means you're willing to put in the time and effort to really research and actively manage your investments.
So for those of us who, are ready to go beyond just picking a few index funds and calling it a day, what does Graham suggest?
He lays out a framework for making those intelligent decisions, but he also warns us about some common traps to avoid. For example, he's He's pretty skeptical about getting swept up in all the excitement surrounding IPOs.
So IPOs, you mean like initial public offerings?
Yes.
Those always seem to generate so much buzz. What's Graham's issue with them?
Well, he's seen time and time again that IPOs are often overpriced. Remember, everyone's trying to get in on the ground floor of the next big thing.
Right.
But historically, they often underperform the market over the long run.
So all that hype doesn't necessarily translate into solid returns for investors.
Exactly. The intelligent investor is focused on value, not hype. And Graham suggests we be wary of new issues in general, especially those involving complex financial structures. He's basically saying if it's too complicated to understand, it's probably not a good investment.
I like that. Keep it simple.
Yeah.
So what else should we watch out for?
Well, he advises against investing in companies that rely too heavily on borrowed money to fuel their growth.
Okay.
Graham calls these companies OPM addicts.
OPM addicts.
Addicted to other people's money.
I love that term. So a company with mountains of debt, it might look like it's growing really fast, but it could be a red flag.
Exactly. That addiction can really hide underlying problems and create this false sense of security. Remember companies like WorldCom or Enron?
Oh yeah.
Excessive debt played a huge role in their downfall.
Right. Okay, so we need to scrutinize the company's financial health, not just get dazzled by their growth story. What about some proactive strategies for the enterprising investor? Where should we be looking for opportunities?
Well, Graham suggests a couple of interesting approaches. One is to hunt for those bargain issues.
Okay.
Those hidden gems that the market has just overlooked. It's like finding a valuable antique at a flea market.
Oh, I love that image.
Yeah.
It sounds exciting. But how do we actually find those diamonds in the rough?
It takes some work, but Graham, he provides some guidance.
Right.
For example, he suggests looking for companies trading for less than their net working capital.
Well, explain that like I'm 5. What does that even mean?
Okay, think of it this way. Net working capital is basically what's left over after you subtract a company's short-term liabilities from its short-term assets. It's basically a measure of its ability to meet its immediate financial obligations. If a company is trading for less than its net working capital, you're essentially getting its fixed assets, like buildings and machinery, for free.
Whoa. So if company's stock price is that low, I mean, there must be something seriously wrong with it, right?
Not necessarily. Sometimes the market it overreacts to negative news or overlooks a company's its hidden potential. Graham, he found numerous examples of these bargain stocks back in his day.
So patience and digging beneath the surface can actually pay off.
Absolutely. And another approach Graham recommends is exploring what he calls special situations.
Okay.
These are kind of unique opportunities that arise from specific events like mergers, acquisitions, or corporate restructurings.
Okay, I'm intrigued. Can you give me an example of a special situation?
Sure. Imagine a company that's being acquired for a price significantly higher than its current market value. Investors who, identify this early on could potentially profit from that difference.
Wow. That's fascinating. It sounds like we need to be, on the lookout for those unusual circumstances where we can capitalize on those market inefficiencies.
Exactly. But remember, even with these more proactive strategies, Graham still emphasizes diversification.
Oh.
Don't put all your eggs in one basket, no matter how tempting the opportunity might seem.
So even though we're being more active, we still need to spread our risk.
Absolutely. Diversification it's a cornerstone of intelligent investing, no matter what your style is. Now let's shift gears a bit and talk about something that can rattle even the most seasoned investor: market fluctuations.
Yes, the ups and downs of the market. I have to admit, even knowing that generally the market goes up over time, those dips can still make my stomach churn a little bit.
I hear you. It's human nature to react emotionally to those swings, but Graham, he provides a really valuable framework for thinking rationally about those market fluctuations. He reminds us that the market isn't always rational.
Right.
Sometimes it gets caught up in these waves of fear or greed that have little to do with a company's true value.
So it's like those times when Mr. Market comes knocking.
Yeah.
And he's he's either wildly optimistic or utterly depressed, even though nothing fundamental has changed about the businesses he's offering to buy or sell.
Exactly. And that's why it's so important to really separate your emotions from your investment decisions. Price fluctuations, they shouldn't dictate your actions unless they present a genuine opportunity to buy low or sell high.
Easier said than done, though.
Right.
Yeah.
How do we stay calm when the market is just going haywire?
Well, Graham emphasizes the importance of the long game. Remember, over long periods of time, the market has always gone up.
Trying to time the market perfectly it's nearly impossible, even for the professionals. He compares it to gambling. You're essentially betting on those short-term fluctuations rather than focusing on those fundamentals.
So instead of trying to predict those short-term swings, what should we be doing?
He advocates for a steady and consistent approach. Remember dollar cost averaging?
Right. We talked about that earlier. I like that it kind of takes the guesswork out of trying to time the market.
Exactly. And for the long-term investor, that kind of consistency is key. Graham emphasizes that the real money is made by staying invested, letting your money compound over time, and resisting that urge to jump in and out of the market based on short-term noise.
So it's about having a plan, sticking to it, and not letting those inevitable market fluctuations derail us.
Precisely. Patience, discipline, a long-term perspective, those are the hallmarks of the intelligent investor. Now, all this talk about analyzing companies and navigating market swings, it might feel a little overwhelming.
Right.
What if someone's just not comfortable picking individual stocks?
Yeah.
Is there another option for the intelligent investor?
Absolutely. Graham, he was a big believer in what he called defensive investing.
Defensive investing.
Yeah. It's basically a strategy designed for those who want to participate in the market, but they don't necessarily have the time or the inclination to really dig deep into individual stocks.
Right.
And the beauty of it is it can be incredibly effective, even for experienced investors.
So what are the core principles of this defensive approach?
Well, it all starts with diversification.
Yeah.
Graham, he recommends building a portfolio of high quality bonds and a selection of leading common stocks. Okay. So not just stocks, but a mix of bonds as well. What's the reasoning behind that?
Well, bonds, they provide that element of stability. They tend to be less volatile than stocks. And they can generate a steady stream of income.
Okay, so it's kind of like a balance, right? The stability of bonds and then the potential growth of stock.
Exactly. And when it comes to those common stocks, Graham, he emphasizes selecting those blue chip companies.
Blue chip companies, you mean like the big well-established companies.
Exactly. Those with a long history of profitability, strong financials, and a proven track record of paying dividends.
Okay, so it's kind of like going with the tried and true, the companies that have, stood the test of time.
Yes, precisely. And here's the thing. You don't need to have a huge portfolio to be diversified. Graham, he suggests a minimum of 10 different stocks, but no more than 30.
Okay. So keep it manageable, right? Don't spread yourself too thin.
Yeah. Now here's a key point about the defensive investor.
Yeah.
They're not trying to time the market, you know? They're not trying to pick the absolute bottom or the absolute top.
They're in it for the long haul.
Exactly. They invest consistently, they hold for the long term, and they rebalance their portfolio periodically to maintain that desired asset allocation.
Okay. So it's all about setting it and kind of forgetting it, at least to a certain extent.
Well, not completely forgetting it.
Right.
You still need to, monitor your investments, make sure they're still meeting your criteria and rebalance as needed. But the idea is to avoid those knee-jerk reactions to every market fluctuation.
So less emotion, more of a systematic approach.
Yeah, exactly. And one of the most powerful aspects of this defensive investing strategy is its simplicity. It doesn't require a deep understanding of financial statements or complex valuation models. It's something that anyone can implement regardless of their financial expertise.
That's really empowering, right? It makes investing accessible to everyone, not just those who, have a finance degree or work on Wall Street.
Absolutely. And one of the most important things that Graham stresses throughout the book is the importance of temperament.
Temperament.
Yeah, he says that the investor's chief problem and even his worst enemy is likely to be himself.
Oh, that's interesting. So it's not just about the numbers. It's about our own psychology.
Exactly. It's about controlling those emotions, avoiding those impulsive decisions, and staying focused on the long-term goals. He really emphasizes the importance of patience, discipline, and having a realistic perspective on the market's ups and downs.
So it's almost like investing is as much a mental game as it is a financial one.
Oh, absolutely. And that's why, even if you don't agree with every single one of Graham's specific recommendations, the real value of the intelligent investor is in its timeless wisdom about human nature and the importance of having that sound investment philosophy.
This has been incredible. This deep dive into the intelligent investor has been eye-opening. Graham's wisdom it truly is timeless. And his book, it's a must-read for anyone who's serious about building wealth and navigating the complexities of the financial world.
I couldn't agree more. And the beauty of it is his principles they're accessible to everyone. You don't need to be a Wall Street whiz to apply them.
Exactly. And remember, the key to intelligent investing is not just understanding the concepts. It's about applying them, consistently and patiently over time. It's a journey, not a destination.
Well said. Well said.
And on that note, we'll wrap up our deep dive into the intelligent investor. We hope you've enjoyed this exploration of Benjamin Graham's timeless wisdom. Until next time, happy investing.